This is Max from UNFTR reporting for the MeidasTouch network, and I've got a deep economic dive for you today, so get ready. U.S. companies are the biggest in the world by market cap, valuation, earnings, you name it. And earnings are healthy and growing. The public equity sector is extremely well capitalized, and the Trump administration's tax cuts and deregulation will theoretically increase earnings. So I guess everything's good. I mean, how's your portfolio doing? Yeah, if everything in the market is so good, why are things so bad? I mean, how broken is our economy? Well, it's story time. But this one is a choose your own adventure because at the very end of this story, we all have a choice to make. One path is the status quo. We let the chips fall where they may and hope that the people in charge of this economy have the wherewithal or desire to fix it. Or we can choose radical transformation. Either way, in the immediate, pain is coming like a freight train, and there's nothing that you or I or anyone can do about it. And what makes this even more precarious is that right now we're flying blind through the storm because of the government shutdown. No economic data and potential mass layoffs in the federal government mean that our instrumentation is down, visibility is near zero, and we're flying on instinct. For years on UNFTR and now on Meidas, I've given the disclaimer that markets are not the economy. Deregulation and tax code changes under Ronald Reagan and the subsequent administrations have basically stripped the stock market of economic fundamentals to the point where it's just a casino, where the house and the high rollers always win. But there are times when the market actually becomes the economy. And right now, the two are on a collision course of epic proportion, a slow-moving disaster where the soulless gamblers in pinstripes collide with an unsuspecting public. Now, these moments are rare. COVID wasn't one of them, for example, because it was an exogenous event with social, health, and economic ramifications. And the dot-com bubble really wasn't either because it was a short-term speculative bubble that didn't bleed out into the broader economy for very long. I mean, yes, there was a recession, but the two weren't totally correlated. We had Black Monday in '87, the savings and loan crisis in 1980, the bear market of '70, the Kennedy slide of '62. Sometimes the markets will just overheat, or they'll get emotional and they'll run down on fear. But that's not what this is. Over the past century, there were two times when the market became the economy and vice versa, 1929 and 2009. So why am I telling you this? Right now, Wall Street is playing with fire. Big tech is lighting money on fire, and the White House is fanning the flames. Now, to be clear, this isn't 1929, nor is it 2009, but there are echoes, and they're getting louder and louder. So we're going to talk about the similarities, but the difference is really where the story lies. And the biggest difference between these events and today is that the banking sector has built a moat, a substantial one, to insulate it from any significant shocks to the system. And for that matter, so have the companies that are listed on the public exchanges. Both sectors are sitting on vast sums of liquid assets from marketable securities to pure cash. Moreover, they have access to the most important funding source in global finance, the United States Federal Reserve, in a more direct and significant way than they ever have in the past. So the order of things varies slightly, but if you look at them in totality, they come together to paint this kind of uneasy picture. So in the 1920s, the stock market was inflated by vehicles called trusts. It was a hollow stock market invention to hold securities in other securities to expand the investable base of the market. What made them more dangerous to the broader market is that they were traded on margin, meaning that they were highly leveraged. In the 2000s, vehicles called swaps and derivatives came into fashion, placing enormous leverage bets on all sorts of securities, most notably the highly secure, or so we thought, U.S. housing market. In the 1920s, investment gains were poured into speculative real estate developments, leading to a bubble, most notably in Florida, which is where the bubble burst for the first time, leading to a national contagion. In the 2000s, investment gains were poured into speculative real estate developments, leading to a bubble, most notably in Florida, which is where the bubble burst for the first time, leading to a national contagion. In the 1920s, the money supply was initially loose, but it tightened over the decade due to constraints of the gold standard. And in the early 2000s, the money supply was relatively loose before the Fed entered a period of tightening in the mid-2000s. So these are the areas that echo. And right now, there's a significant amount of leverage in the market, though I'll give you an important caveat to this when we talk about the moat surrounding the banking sector. We still have swaps and derivatives and trust-like investments called SPACs, but they're way more contained than they were in prior periods. The speculative bubble that everyone is talking about right now, of course, is the AI bubble. It's estimated that there have already been upwards of $1.5 trillion invested into AI infrastructure. And once again, we have a housing bubble built up after COVID, and it all started in Florida. But it has expanded to places like Austin, Texas, all throughout Arizona and other parts of the country. And we're already seeing home prices start to collapse in certain areas, and people are falling behind on mortgage payments. And lastly, we just came through another expansionary monetary cycle with the Fed propping up the banking system before a slow tightening over the past couple of years and reaching a critical point in the back half of 2025. So there are direct parallels between the run-ups to the major market and economic collapses that we've seen in the past. Now, here's the part that differs greatly. The root causes of 2009 and 2009 were speculation and deregulation. Basically, the financial markets were just allowed to run amok with little oversight and a ton of leverage. And yes, that's where we are today. But in 2009, it had been so long since the Great Depression that there was no muscle memory or even institutional memory from this period. And so things were allowed to slowly unravel over a period of decades. Additionally, the absolute constraints on the money supply under the gold standard in the Depression meant that there was no ability to run up massive deficits to prop up the financial system. So when the crash began in 2008, the government had the capacity to step in and build a floor for the market in 2009. Now, we can argue whether it was enough, it wasn't, or if the government acted to protect the banks more than the consumers, they did. But they did act to prevent a complete and utter collapse like the Great Depression. Now, here's where it gets tricky, so bear with me. All right, so let's talk monetary versus fiscal policy. Fun, right? Monetary policy is basically managing the supply of money, the cost of money, and where it goes. Fiscal policy is everything else, from budgets to regulation. Now, in the wake of the Great Depression, there was an absolute supply of money, which meant that the government could try to manage the cost of money, but not the amount of it. So the government had to rely on fiscal policy measures as well. Sometimes austerity, other times investments, social insurance, regulations like Glass-Steagall to prevent reckless behavior. But without an overabundance of money and an ability to run massive deficits, the recovery was slow and painful because they were writing the playbook as they went along. Now, in the wake of the Great Recession, we had monetary and fiscal measures at our disposal, so the Obama administration threw the kitchen sink, or so they thought, at the entire problem. Now, it helps that the dollar is the world's reserve currency now, so the United States has the unique ability to issue tremendous amount of debt to recapitalize the system in the wake of a crisis. And that's what we did from 2009 to about 2016 when the Fed began tightening again. So we printed an enormous sum of money and sent it coursing through the system. The Federal Reserve purchased toxic assets directly from corporate and bank balance sheets. We took interest rates to almost zero to encourage borrowing and investing. We sent stimulus checks to consumers. We sent money to states to balance their budgets. We invested in infrastructure projects to get companies and people working. We extended unemployment benefits and healthcare subsidies and so on. And it still took years to emerge from that crisis. And as I've argued many times before, a substantial portion of Americans never actually recovered, and they've been living in a state of economic precarity this entire time. And even though new bank regulations came into existence, most notably the Dodd-Frank legislation and reserve requirements for banks, they paled in comparison to the old ones that were put in place during the Great Depression. But Wall Street and corporate America were always going to find a way to work around the regulations. And right now, there are three areas of the financialized economy that exist outside of the highly regulated system that are beginning to crack. We've got the subprime market, private capital, and artificial intelligence. Now, the reason I went through the historical exercise first is to illustrate the fundamental differences between these major economic events. Not necessarily in how they came about, although that's part of the story, but in how we responded and how we were able to respond. So now let's walk through the three areas of the economy that mostly exist outside of the regulatory purview of the government and how failures in one or maybe all of these sectors could bleed out to the real economy. We'll set these potential fail points against current data as well to get a sense of where we are and where we're headed. All right, so our first sector is the subprime market. Approximately 1 in 5 Americans are considered, quote, subprime borrowers, meaning that their credit profile subjects them to higher borrowing rates from mortgages and auto loans to credit cards and payday loans. This segment of the population is already in crisis, as bankruptcies have risen 11.5% year over year so far. And we have new data sets being released later this month, assuming we can even get our hands on it. Subprime auto loan defaults have increased, and so have the share of delinquencies for FHA mortgages. Now, case in point, Tricolor, one of the largest subprime auto lenders, just filed for bankruptcy. And while this might seem contained, remember, that's what they said about the subprime housing market in 2008. Then we've got the private credit market. This market is also enormous, although it's more challenging to determine who's participating in it. I mean, we know who's doing the lending and the investing. This is private equity firms, venture capital firms, hedge funds. But the class of borrowers is harder to determine because it's a private marketplace. Now, what we do know is that the market has grown by $500 billion in just the past year. So it's around $1.5 trillion right now, and Morgan Stanley expects it to top out at $2 trillion in 2026. But there's a growing trend for what's called PIK, or payment in kind. Essentially, outstanding interest payments and dividends aren't being paid in cash, but they're being paid in securities, meaning that companies that have these facilities can't make their interest payments. So they're giving up more equity in their companies. That's a bad trend. And of course, the big one that you're probably seeing a lot about these days is artificial intelligence. Now, the big question on everyone's mind is whether or not we're in some sort of bubble. And here's the short answer. Yeah. Oh my God. Yeah. This sector has hoovered up hundreds of billions of dollars in investment capital, maybe more. And it has almost nothing to show for it on the surface. So the two biggest players in AI, and I'm talking pure AI companies, are OpenAI and Anthropic. Now, there are countless companies that are utilizing different aspects of AI technology. They're building it into their systems and they're developing an ecosystem of products around them. But in terms of companies at the bleeding edge of building AI systems alone, those are the two big guys. So OpenAI is expected to do around $12 billion in revenue this year, and it's going to bleed cash of about $8 billion. Anthropic is projected to do around $3 billion total revenue, and it too hemorrhages cash. So let me put that in perspective to pinpoint the problem. Compare the revenue of those two giants in the industry, $12 billion and $3 billion, to the true giants. Projected revenue for Amazon in 2025 is $700 billion. Alphabet, Google's parent company, $370 billion. Microsoft, $280 billion. Meta, $178 billion. Now, you might be wondering why I didn't include NVIDIA in this equation. And good on you if you caught that. NVIDIA is the company with the highest valuation on Wall Street. It's the best performing stock. It's the chip maker that's powering the AI revolution. Now, forecasters believe that NVIDIA will do about $130 billion in revenue this year. That is substantial, but here's the catch. And this is what has everyone scratching their heads. Recent SEC filings confirm that 39% of NVIDIA's revenue in the second quarter of this year came from just two customers, referred to as Customer A and Customer B. Of the total quarterly revenue, Customer A was 23% and Customer B was 16%, and they do not publicly disclose their identities in their filings. But there's a better than even chance that two of those companies are from the other ones that I just mentioned. Now, these companies might be using NVIDIA chips and GPUs to power their own internal initiatives, but these companies don't even have AI revenue line items. I mean, Meta, for example, used to break it out, but the figures were so paltry, they stopped reporting them altogether. So now we're left to wonder, where's all this capital going? And then there's this circular problem.
Now, the deal also highlights a growing circularity in how AI is being financed. NVIDIA gives capital to OpenAI. OpenAI uses that cash to buy NVIDIA chips. And it's the same with AMD in a sense, only this time OpenAI is getting equity virtually for free and could eventually cash it out to then pay for the very chips that AMD supplies. It is a closed loop of capital, compute, and equity, with OpenAI at the center orchestrating the flow.
Right, so remember that PIK issue that we identified in private credit? That's how many of the AI deals look these days. For example, Microsoft put $13 billion directly into OpenAI, but another $100 billion in equity through a different holding company. OpenAI has a supplier financing arrangement with NVIDIA of $100 billion, and Microsoft is said to represent about, maybe, they think, 20% of NVIDIA's revenue. Now, don't get me wrong. Increases in efficiency and automation have been incredible. And that's almost the whole point here. The big companies are getting bigger and more efficient. And they're so heavily invested in one another that it's almost becoming a single concern. Oracle, Alphabet, Amazon, NVIDIA, Meta, Microsoft, these giants are piling investments into a company that can only stand up $12 billion in revenue on its own, just to make sure that the tech giants have inside and preferred access to technologies that are making them even bigger and faster. So, yeah, AI is a fraud in terms of a standalone business model right now and probably for years to come. And at the same time, tech is real. It's building a competitive advantage for organizations that already have market leader share. So there's a larger conversation to have at another time about where the AI investment and this compute belongs in terms of our national interests. But for now, let's look at some of the real economy data to explain how things can be so good on Wall Street and so bad in the real economy. All right, so we started this episode talking about corporate earnings and performance, and this is where the disconnect really lies. Outside of the AI investment bubble propping up the value of the stock market, it is also the case that public companies in the United States are performing quite well. So this is why you haven't seen a pullback on Wall Street just yet, and why some pundits and observers think that the recession and market crash talk is just hyperbole. In fact, a lot of them are starting to talk about a re-acceleration of the economy. But on Main Street, the suffering is real and it's getting worse by the week. All right, so let's begin with the labor market. Now, in prior episodes, we've carefully walked through how only 62% of this country, 18 and over, are gainfully employed in this economy. That's the labor participation rate. And if you factor in kids under 18, it falls to just above 50%. So in absolute terms, half of this country is supporting the other half. Now get this, every day, approximately 11,000 baby boomers retire. Now, the next generation is entering the workforce, but at a slower pace this year because of a slowdown in hiring in multiple sectors. Now, this is the backdrop to a labor market that also features 70 million Americans who work in the gig economy, either to provide their main source of income and they're not counted on the rolls, or to supplement their income because they can't make ends meet. This is one of the reasons that a government shutdown is so frustrating at this critical juncture. We have to wait for the BLS and other agencies to catch up when the government reopens, and this is on top of the fact that they already work with lagging indicators. So even in the best of times, the government figures that we receive are estimates because they're constantly being revised. But the data that we can access from private sources also tells a story about what's happening in the labor economy, and right now, it's a horror story. So let's start with the service sector. This is about 70% of GDP, mind you. So with continuing losses in manufacturing jobs, despite the lies coming from this administration, the service sector has been propping up the job market. But the most recent ISM services activity shows a steep decline in August and September, with price inputs increasing and new orders slowing, leading the survey to conclude that the services sector has, quote, stalled. The ADP private payroll figures also showed a total loss of 32,000 jobs in September, building on a continuing trend, but it's where these losses occur that feed into our storyline. Here again, we see that the big guys are holding steady. Now, 33,000 additional jobs isn't a lot to write home about, but it is forward momentum. But in the small to mid-sized companies, things are continuing to deteriorate, and that's why there was a net loss overall of 32,000. So if we head over to the other large private aggregator of corporate job data, Challenger Gray and Christmas, we can see the volume of planned job cuts and planned hiring, both of which are telling. So let's start with job cuts. So what you're looking at here are all the survey results among companies that said they're planning job cuts in the immediate future. So while the pace has slowed since the spike at the beginning of the year, the figures remain elevated. And when taken in totality over the whole year, we're talking about cuts that equate to the total of the eliminations during the pandemic. But the news gets even worse when we talk about planned hiring, and these are the figures that caused another fracture in the market that I'll show you right after. This graph shows planned hiring for the year. So as the text here states, planned additions this year are down 58% from where we were a year ago. We're already in low territory, but the announcements from retail giants like Walmart and Target revealed that retailers are bracing for an incredibly slow holiday season. So the number of seasonal workers are going to be decimated over prior years to figures that we haven't seen since 2009. So now here's where the stress fractures begin to show up. I'm going to give you 3 charts that show how weak labor figures and a significant slump in consumer spending that are being forecast for the remainder of the year are causing other indices to implode. The first is gold prices. Gold prices are at record highs because private and official sources are flocking to stable commodities like gold and silver. It's also a reflection of central banks beginning to hoard gold to protect their own currencies in preparation of a global financial shock. This is a significant warning sign that we cannot ignore in the context of global market activities. Now, the second one is something that we've covered before. This is the Fed's overnight repo market. So what you're looking at here are moments when the Federal Reserve has had to jump into the overnight settlement markets to inject momentary liquidity to ensure that markets don't seize up. So every day, trillions of dollars flow through the settlement markets with private and central banks providing overnight loans to guarantee that trades settle out while money exchanges hands. It's a really neat invention that ensures that if a counterparty or multiple counterparties suddenly run into cash flow issues, that trades don't go belly up. Now, it's extremely rare that the Fed has to step in and inject excess liquidity into the system, but those spikes you're looking at are just that. Now, I have to stress the point that at the end of every fiscal quarter, activity in these repo markets spikes because companies will just move a bunch of trades on and off their balance sheets to kind of spruce up their books for quarter end reporting. So this can happen, but everyone knew that cracks were already showing up in the system, and there was a ton of chatter in advance of the end of Q3. So companies all over the country were preparing for this, and they were shoring up their balance sheets well in advance of September 30. And the Fed still had to backstop the market. But the real concern was that it had to hang around in it for a couple of days to work out all the settlements. That's not a good sign of things to come, especially when there's so much off-book activity in the private credit market. And that brings us to maybe the most important headline. We finance our debt through treasury auctions. Now, rule of thumb, higher yields are essentially risk premiums. This is the cost of the money that we bring into the country to pay our bills, since we don't collect enough in taxes from the rich, or we don't charge enough tariffs to our corporations to close the budget deficit. So when the world thinks we're doing a good job in managing our economy, the yields will be lower and more competitive, which means the cost of financing our deficits decreases. But as this headline indicates, the services and labor data that we just went through in conjunction with the government shutdown spooked the market and kept treasury yields higher than the government had hoped. So Trump keeps claiming that the tariffs are bringing in so much revenue we don't know what to do with it. So much, in fact, that he still said it again that he might consider giving every American a rebate check. It's a lie on both counts. The Treasury Secretary keeps claiming that our tariff auctions are successful because he's moving away from long-term treasuries to short-term notes that are priced lower, essentially replacing expensive long-term debt for less expensive short-term debt. And this is a half-truth. The reason the yields remain stubbornly high is because global investors are losing faith in our ability to manage the economy. So he is indeed moving to shorter-term investments, but he's having to auction more and more treasuries because we keep falling short of our desired outcomes. Now let's pull all of this together before I lay out our choose your own adventure options. Look at these men: Charles Mitchell, John Raskob, William Potter, Albert Wiggin, Thomas Lamont. These were just some of the most notable names on Wall Street in 1929, a mix of titans of finance, economic scholars, and investment bankers who came down from their ivory towers to declare the stock market was stable and growing, the fundamentals of the economy were sound, and the bull would continue to run, perhaps in perpetuity. Yeah, Wall Street thought it had cracked the code, and the good times were never going to end. The market had rallied off of earlier fears to reach its zenith, and the Wall Street Journal published its thought of the day on September 11th, 1929. Don't part with your illusions. When they are gone, you may still exist, but you have ceased to live. The writer of these words was Mark Twain, and a week later, the crash began in earnest. Now, the next time that the Dow Jones Industrial Average would reach the peak from when these words appeared was 1954. That's 25 years. And here's the thing. There's a modern notion that everyone and their grandmother was invested in the stock market during the 1920s, and that is actually very far from the case. At the time of the crash, there were only 1.5 million individual accounts out of a population of 120 million. There are way more people per capita and in total who are invested in the stock market today, though primarily through qualified retirement plans. But it's not how many people that should concern us. It's where the concentration lies. According to Money Magazine, quote, the share of equities held by people who are at or near retirement age has climbed to about 80%, up from 60% 2 decades ago. And Americans 70 and older now have an astonishing 30% share. So that means seniors are the most vulnerable to a market decline or crash. So here's what we can say with confidence right now. The 1 in 5 Americans who are considered subprime are already in crisis. So that's 20% of us. Every day, 11,000 baby boomers become retirees. And some will do part-time and gig work to supplement their income because less than half of boomers already have enough savings to retire comfortably. But among those who have enough money to retire, their savings are locked in 2 places: the market and their homes. So if we have a market downturn, or if home prices collapse, both a distinct possibility, then even more seniors will be on the edge. We know that the labor market is in a steep decline, and it's going to bottom out further during the holidays. We know that prices are increasing due to tariffs, and inflation is expected to remain at least around 3% for the foreseeable future. Mass layoffs are coming. Prices are going to remain elevated, and our deficit is going to increase beyond even the most updated CBO estimates. Is there any wonder why the GOP is okay with a government shutdown? They don't want this information getting out there. But what about what we can't see? It's hard to say what's causing these liquidity shocks, for example. Is it the stuff that we can't see in the private credit market? Is it the subprime lending market that's maybe way worse than we thought? How leveraged are these private companies? Stephen Miron, the new Fed governor currently on leave from the White House, has stated publicly that Trump's mass deportation policy is going to alleviate the housing market. Rents are going to come down because we'll just have fewer immigrants, he says. So essentially, one of their goals is to cause a housing price correction by deporting tenants. What about those seniors who have all their money tied up in home equity? You see how hard this balancing act is when you really actually don't have an economic plan? Now, the GOP likes to claim that everything is fine, that everything that they do is fiscally prudent to get control of our deficits. Hell, that's why they have to stay strong in the face of Democrat demands to keep subsidies for Medicaid in the budget. We just can't afford it. Now, here again, numbers are the damnedest thing. All we have to do is look at the actual federal budget, which they're required to publish. I'll put a link to the budget in the notes so you don't have to squint to see the detail here, but here's what the federal budget reveals about GOP priorities. Despite Trump's claim that his people were surprised to find hundreds of billions of surplus dollars from his tariff policy, the budget actually reveals that it's around $96 billion in excess of last year. Don't get me wrong. That's a lot of money, But there is the nagging reality that we're the ones who paid it. It's just all getting flushed through to the consumer eventually as well. But it's the expense side that really reveals all. So far this year, the administration has increased funding in the following places, and you might find this surprising: agriculture, defense, HHS, which is Medicaid and Medicare, Homeland Security, transportation, the Treasury, Veterans Administration, and Social Insurance Administration. And over the same period, here are the areas that have been slashed. They took $111 billion from education, $1 billion from HUD, and $8 billion from the Department of Labor. So, in practical terms, that means that education, housing, and labor were the only places that were cut so far. Everything else increased under this fiscally prudent, cost-cutting, Doge-promoting Trump administration. They're just liars. And that leaves us with an interesting figure that factors into two places, and that figure is $76 billion. The deficit increased by $76 billion to a total of $1.9 trillion so far. Staggering. Also, the interest on public debt increased by the exact same amount, $76 billion. You see, they can run, but they can't hide. Not from numbers. So where does this leave us? If the AI bubble pops, the stock market will come down. Now, it's unlikely to collapse because of the capitalization of the banks and the stable earnings of companies outside of AI. But if the big AI companies do come down, and then retail sales slump, it will eat into earnings of companies like Walmart and Target and so on. And if the labor numbers continue to decline, it'll have a drag on consumer spending, which will eat into earnings across the board. So what is it, 1%? 5% down? It's hard to tell. But given the irrational exuberance of the market and the elevated PE ratios that we have right now, which are historic, by the way, it's more than likely that this kind of confluence will lead to a correction of sorts in a minimum. And if this correction eats away at the income from retirement accounts and home values begin to come down, this puts boomers in a pretty tight spot. Not the really wealthy ones, but the ones who no longer have a place in this tech-forward and service economy. You remember those men? The titans of finance who assured the world that the markets were stable and the fundamentals were sound right before the biggest economic collapse in history? They were really confident because when you're in the bubble, it's hard to see outside of it. Because had they looked outside of the bubble at that time in 1929, they would have seen that the real economy was already in a recession well before the market collapsed. And if anyone in the political class or in corporate America today could step outside of their bubble, they would also know that the bottom of this market has collapsed entirely, and the data show that it's working its way up the ladder and destroying the middle class, and it's going even further than that. And yet, as we started this entire episode saying, corporate earnings are stable, banks and large firms flush with cash, and the Fed stands at the ready to inject cash into the system in the event that it does come crashing down. The bottom line is, they can keep this up much, much longer than we can, because they've hoarded all of the cash and they've held on to it. And this is before the real corporate and high net worth tax cuts really take effect. Oh, and they hold the keys to the money printing machine in the basement of the Fed. You see, they really did learn lessons from the prior collapses. AI might be a bust for investors, but the computing power has already helped corporations increase efficiency to do more with less. And that less, by the way, is us. The financial institutions know that if the market tanks, the Fed will stand up their outstanding claims. So the banks won't fail this time around. The private credit companies might, but not Wall Street proper. If we have a convergence where the market becomes the economy and vice versa, and it all bleeds out, they control all the mechanisms to bail themselves out through monetary policy, and that leaves the rest of us at the mercy of fiscal policies, led by this administration. But the interest on our debt is going to grow. Doesn't matter how many federal employees they fire without back pay. Doesn't matter how much they cut from Medicaid or education to further devastate the poor and the working class. It doesn't matter how much they slash from HUD or the Department of Labor. We have 3.5 more years of rising deficits, tax cuts for the wealthy, absurd increases to the military both here and abroad, $1 trillion here and $1 trillion there. That's what we have to live with. For all the mismanagement of the Wall Street crash in 1929, I can tell you this much. Herbert Hoover was no idiot. This was an incredibly bright and competent man with a good heart, who just wasn't up to the task, nor did he possess the monetary tools to save us, even if he was. Barack Obama, not an idiot. He's an incredibly bright and competent man, also with a good heart, who saved us from the global financial crash. But he didn't use all the tools at his disposal to deliver salvation for the vast majority of Americans, and because of that, we got this guy, a man who is neither capable nor in possession of a good heart. Thus, the unavoidable pain we're about to endure, especially if the markets and real economy converge and it all falls in on itself. And so here's the choice. Our choice is not today, but it's a year from now, and then again in 3 years. Our problems now are bigger than they were in 2009. Our economy is way bigger and more global than it was in 1929. So the echoes are loud, but the circumstances are vastly different. So if we vote for the status quo, if we return figures like Hakeem Jeffries and Chuck Schumer to leadership positions, if we don't stretch to imagine something more significant than capable technocrats like Obama, if we retreat to the comfort of status quo without realizing how fundamentally different the challenges are that we face and the magnitude of the power imbalance between corporate America and the rest of us, then we will be active participants in the closing chapter of the American experiment as the hegemonic power of the world, or worse. When we talk about radical change, it's more than window dressing in the status quo. It means Medicare for all. Enormous structural changes to the tax code, taking power away from corporations through regulatory channels, cutting our military spending in half, and channeling much of that toward a civilian labor corps to perform the difficult task of building a climate-resilient infrastructure. Wholesale reform of student loan programs to eradicate enormous portions of expensive and long-held debt and refinancing the rest of it at the same rates the banks borrow money. Corporate America hasn't just built a moat of money around it, they're building the computing infrastructure to replace us, while we pick up the cost of powering them through our own energy bills. All of that money that goes to ICE should go toward building deep economic and trade alliances with our Latin American neighbors and partners so that their citizens don't have to risk their lives fleeing their countries for economic opportunity. Am I talking about redistribution of wealth? You better believe it. Corporations are sitting on $3 to $5 trillion in cash and marketable securities. Wealthy individuals and multinational U.S. corporations are parking $4 trillion in offshore accounts, and we know that from the Panama Papers. U.S. banks are sitting on $3.5 trillion in cash and securities because they have to report it. So that's over $10 trillion just sitting there. I say they can't have it all anymore. It's as simple as that. The status quo on both sides of the aisle lets them keep it all while we suffer through what might be another Great Recession or worse. Now, they'll tell you the radical left is coming for your guns. No, we're not. Just your money. They'll tell you the radical left wants widespread political violence. No, we don't. We want comprehensive, universal health care. They'll tell you the radical left wants everything for free. Nope. We just want what's ours. If there's a Democratic primary where you live next year and you hear one candidate talk about the status quo and another who has a radical vision of reducing inequality, providing health care, and taxing the rich, get radical. If there's a slate of presidential candidates in a couple of years running to fix the depression economy that Trump leaves us with, get radical. There's nothing violent about the radical left. So while you're at it, let's reclaim that label and wear it proudly. Because we don't have to hold the country hostage at gunpoint like the right does. We just need to think bigger, show up, and get radical. For the MeidasTouch Network, I'm Max from UNFTR. You can find me on YouTube and Blue Sky at UNFTR. You can also sign up for our free weekly newsletter at UNFTR.com. And as always, thank you so much to the Meidas Mighty for having me here. I'll catch you next time.
Love this video? Support independent media and unlock exclusive content, ad-free videos, and custom emojis by becoming a paid member of our YouTube channel today. You can also gift memberships to others. Let's keep growing together.